Have you ever looked at the national debt, trillions upon trillions of dollars, and wondered, how are we ever going to pay this back? Usually, we think there are only two ways: raising taxes or cutting spending. Both are incredibly unpopular. Politicians hate them because they lose elections. But what if I told you there was a third way? A hidden method. It's called financial repression. And it's not some wild conspiracy theory. It is literally the title of a famous IMF working paper by economists Carmen Reinhart and Belén Brancher. The scary part? It's likely happening right now. So, what exactly is it? Financial repression is a subtle method governments use to liquidate, or wipe out, the value of their debt without explicitly defaulting. It effectively works as a stealth tax on savers. That means you. Here is the formula. It requires 3 key ingredients to work. Ingredient 1. Negative real interest rates. This happens when the interest you earn in your savings account or on a bond is lower than the rate of inflation. Think about it. If your bank pays you 2%, but inflation is running at 5%, you aren't making money. You are actually losing 3% of your purchasing power every single year. So who wins in this scenario? The borrower. And who is the biggest borrower in the world? The government. But wait, you might ask, why would banks buy government debt if the return is so bad? That brings us to ingredient 2, the captive audience. The government uses a web of complex regulations, with really boring names like Basel III or liquidity coverage ratios, to force institutions to buy their debt. They effectively tell banks, if you lend money to a small business, that's risky, so we will charge you. But if you lend to the government, that's zero risk. In fact, it's practically free. So banks, pension funds, and insurance companies are herded into buying government bonds, no matter how low the yield is. They become a captive audience. This creates artificial demand that keeps the government's borrowing costs near zero. And finally, ingredient 3, inflation. You don't need hyperinflation like in a history book. You just need inflation to be slightly and consistently higher than interest rates for a long, long time. This isn't just theory. The US and UK did this exact thing after World War II. From 1945 all the way to 1980, they used this playbook to melt away their massive war debts. It quietly reduced debt by roughly 3 to 4% of GDP every single year. So, why does this matter to you today? Because government debt levels are skyrocketing once again. And those boring regulations? They are tighter than ever. Your pension fund is loaded with government bonds. Your bank account is paying you far less than the rate of inflation. The liquidation is happening as we speak. It's a slow, silent transfer of wealth from your savings to the national debt. The government doesn't need to raise your income taxes to pay off its debt. It just needs you to hold onto your cash while they slowly inflate away its value over time. If you want to know how you can protect your portfolio from the effects of financial repression, check out our next video where we'll break down hard assets versus paper money. Thanks for watching, and don't forget to subscribe.